Hi, let's learn something new today in another video with Professor Choi. Do remember to like the video and subscribe. And here is today's video. I'm going to make another video about investing for beginners. Now, I always try to explain to people that when you're buying stocks in the stock market, you don't really look for the cheapest stock. Because just like when you buy things outside, sometimes the cheapest stock is cheap because it's bad. So it's not really a find the bottom all the time. In other words, something that's 50 cents may not really be 50 cents and it's cheap. It's 50 cents maybe because it's worth 50 cents. Alright? So there has to be different ways of you to analyzing this, and price is usually not a way to look at it. There has to be more than just price. Maybe relative price. But anyway, so today we're going to talk a little bit about why buying a cheap stock doesn't mean buying cheap in dollars. It actually means cheap in PE, or price to earnings ratio. The PE ratio is something heavily used by the entire financial industry to figure out the relative cheapness of something. It's also known as the multiple. Alright? And they usually don't use the word cheap, they use value, the word value. So basically, a value play is something with a low PE and good potential, while something that's overvalued, it's something with a very high PE. Alright? So the PE ratio is constructed by using the price per share dividing earnings per share. And the earnings per share is basically the amount of earnings that the company has divided by the amount of shares outstanding. So let's take a look at how these formulas will react when you change them. So for example, if the price of a company goes up, in other words, it's selling at a higher price in the market, then the price per share will increase, and so will your PE ratio. Okay? Now, what would happen though if the company has higher earnings, aka it's making more money? Well, what would happen is your PE ratio will go down. So, a low PE usually means that the company has higher earnings than the price of the share. A high PE ratio usually means that the earnings are lower compared to the price of the share. So a low PE ratio usually means that a company is being undervalued. In other words, they're not paying the correct price for this company. And of course, usually when you're comparing PEs, you do it within the same industry. So a sort of relative PE. Alright, now to understand again the difference between price and using PE instead, let's take a look at these two companies. So let's say I have company A with a market cap of $1,000, and look at company B has the same market cap, and we have 100 stock outstanding for company A, 1,000 stock outstanding for company B. The way we calculate the price of a stock, it's basically using market cap equals the stock price times the number of shares outstanding. So the way we know a particular market cap for a company is we take all the stock that they have and then we multiply times the number of shares outstanding, and that's how we come up with a market cap. Which also tells us that the price of the stock is the market cap divided by the number of shares outstanding. So if we divide this market cap by this amount of shares, you get $10 market price. But if you take this market cap divided by 1,000 shares, you get this market price. So a low market price does not mean a stock is cheap. It basically means that maybe you have more shares outstanding. Or it could also mean that you have a lower market cap. Okay? And again, the reason I'm explaining this is because I need you to understand that cheap in the market doesn't mean cheap. In other words, a low price stock can be low price for multiple reasons that have nothing to do with whether the company is cheap. Okay? So you have to use more metrics to try to figure out whether something is cheap or not. Alright? So the price of the stock is not what should determine your purchasing decision. And I hear this a lot. I hear people, oh, but it's 50 cents. It's cheap. And I go, no. Sometimes 50 cents is expensive because that company might not be making any money. So 50 cents is worthless if you're not making any money. And they go, well, but everything that goes down goes up. And I'm like, no, that's not how it works. Okay? Some things go bankrupt. All right, so instead, you need to be using more metrics. Something like the PE ratio. Again, a low PE means that something is relatively cheaper compared to another company. So if you have, say, a similar type of company, so let's say company A and company B are in the same field and they're relative competitors. So if this one has an earnings per share, if this has a PE ratio of say 11, while this one has a PE ratio of say 25, then the company with a lower PE ratio is relatively cheaper compared to that one in the same field, and therefore a relative better value for you to buy, assuming earnings are either flat or increasing. All right, so instead, what do you need to look at? Well, the price of a stock has all to do with the future, okay? Has to do with future earnings. So you got to look at, are the earnings growing? Are sales growing? How is the future looking for this company? For example, companies like Netflix or Facebook that have the amount of money that they make depends on the amount of people that are using the platform. Are they having subscriber growth? Are they having customer growth? If you see growth in the company, then this is a good thing. Okay? And sometimes people are willing to pay a higher PE for something that's growing very quickly. And why is that? Well, imagine that this PE is already very high. Now, if the earnings are growing, then that's okay because eventually the PE will come down to normal. So sometimes companies that are growing very quickly will have a higher PE or higher multiple, and that's because people are willing to pay for that future growth that's eventually coming. Another reason why you want to buy a stock or not, it's because it pays dividends. Dividends is money that they give you just for being a stock owner in that company. And a lot of the times you want to build a portfolio that has a little bit of constant paying into the portfolio and a little bit of growth. You don't want to be on either one completely, because if you're just constantly on dividend, you're never going to grow. And if you're just constantly on growth, then at some point growth turns into sunk, and then your portfolio goes from like whoop to whoop very quickly. Okay? So you got to have a little bit of both. The last one that you have to look at is the secular trends. What exactly is happening in the future? You know, right now, for example, there's a huge secular trend towards online for a lot of things. So online purchasing, online buying this, online buying cars, online this and that. That basically means that's bad for retail. So in general, retail is doing worse than online. So what is the next big thing? You know, is this company in the next big thing? If retail's out, for example, online's in, electric is in, regular cars are out, or Zoom's in, but face-to-face is out, okay? So you have to, these are basically the main things that you have to be looking at when you're thinking about purchasing a company in the stock market. And price of the company, it's not really quite what you need to be looking at. All right, so anyway, this has been another video by Professor Choi. Hopefully it's been useful to you. If you like my videos, remember to like it and subscribe. Have a good one.